As you're aware, 2022 has been a difficult year for most asset classes. Just how bad? Well, for bonds, it's been one of the worst performing years in the last 90 years. A long-term bond portfolio is down roughly 20%, and an aggregate bond fund is down 14% as of this writing. Usually, when equity markets are in bear territory, we get some kind of reprieve from bonds. As you can see in this chart, even in 2008, when stocks were negative, bonds generated a positive return. This hasn't been the case in 2022, unfortunately. The average 60-40 balanced fund is having one of its worst years on record, both on the US and on the Canadian side. We've made some strategic transactions to reduce some of the impact of current markets. These changes have provided some good relative results, but as with everything else this year, the absolute returns are still negative. The positioning, however, sets us up positively for when things stabilize and recover. Firstly, as you know from our conversations over the last several years, we've been bearish on bonds and have made a large shift into alternative investments. These have brought us a positive return this year and continue to perform consistently. We've continued to add real assets such as agriculture, infrastructure, and power producers to our portfolios, which have an implicit embedded inflation protection already. Other changes to note, we eliminated our emerging markets exposure at the beginning of the year and have no direct exposure to China. We've also reduced our exposure to Europe, hedged the euro, and eliminated some of the higher value tech companies. We used the liquidity to purchase additional defensive positions similar to the ones we already own, with pricing power that are recession resilient and have strong balance sheets. Our healthy exposure to the US dollar, the safe haven currency, has also helped to offset some losses. And although we haven't seen the full fruits of our labor, when things turn around, and they will turn around, we're going to benefit from the adjustments on the upside. Right now, the level of pessimism is extremely high, similar to 2008 when financial institutions were defaulting and jobs were scarce. Markets are as pessimistic now as in the early 80s when rates were at 18% and more, even as much as in the Great Depression. Traditionally, when individuals and markets are this pessimistic, the next 3 to 5 years have historically been quite strong. And needless to say, the monetary policy, support programs, strong employment, and strong balance sheets we have today are much more robust than they were in the past. In addition, when we've seen 20% drawdowns in the US market, as a reference, we hit minus 25% on October 12th, the following 3 and 5 years have been very strong. The key takeaway? We know this is a difficult time for the economy and the world in general. It's even difficult for investors to look at their statements these days. But over the last 25 years, we've seen many similar instances with slightly different circumstances. One thing we know is a portfolio built with a robust investment process and with a focus on the long term has always and will always pay off. On behalf of the TWM Group, thank you for watching and see you next time.